Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Weakness is persisting. There are more names on the downside of the screen. For instance, Z Entertainment is now losing about 4% as we speak. Mitesh, your thoughts? I mean, there are a lot of names on Nifty also on the downside. For instance, Z, weight sliding, ONGC. Specifically on the oil and gas play, any fresh trades, long or short, on either side of the spectrum?
I think the one which I like is Gas Authority. It's given a good breakout on Tuesday, and since then it's been sideways. So I think around this 350, 351 zone, I think there's a big support or big level which it was able to cross. I don't expect the stock to go below those levels again. So around 351 would be a good buying idea. Keep a stop below 346 or so, and I think the stock should head towards 380. In fact, it's managed to kind of survive the carnage which other stocks have suffered apart from the top 8-10 stocks. And I think this still looks very promising to me. And Reliance, of course, is clearly a buy. But I don't think there's any strength in the rest of the pack.
Okay, well, for now, also keep tracking Infosys closely. Ahead of its numbers, it's come off a little bit from the highs. It's still holding with gains of almost 1%, but from the 1330 mark, it's come off now, trading at around 1300 or so. Let's get you some market opinion as well. The market is at record highs, but it is a very narrow rally. That's what a lot of the experts also have indicated. And significant underperformance is what we've seen in the mid-cap space. Let's listen in to what Arvind Sanger has to say, his view on the earnings season and the sectors that he likes now.
Company's earnings season is off to a good start, and we should get some good results and some good signs of momentum from companies across different sectors. The mid caps are clearly lagging in a big way, and it is a very narrow rally. The problem with narrow rallies is either they broaden or they fail. And to me, the jury is out on which way that will go, because a very narrow rally which causes the index to go higher without broad-based participation is not a healthy sign. The other risk factor remains global potential risk from trade. So, is China going to blink and back down and come to the table and do a deal with the US? Or is China going to dig at its heels? So these are things that I'm not confident one way or the other to make a big call. So we remain somewhat cautious, but looking for opportunities to buy individual names. And the rally right now is not that convincing because it's so narrow. I think that we've seen enough signs that the fears about the H-1Bs and the fears about clamp down on outsourcing, all those are passing, and the Indian companies have right-sized and stabilized their focus on the digital versus the traditional channels of business, and therefore I think that we could see the next wave of the growth cycle, especially for those companies that have right-sized themselves sufficiently.
That was Arvind sharing his views in the market and, of course, the IT universe with us. The one stock that's had an interesting couple of days, very choppy ride, is Adani Enterprises. Right now, the stock's up about 6% in a market like this one. So that's one stock on the gainers list. Deepan, any thoughts on Adani Enterprises? There was some excitement around the city gas distribution bids, etc. Any views on this one?
No, sorry to disappoint. I think we're not tracking Adani Enterprises, and kind of the company has fallen off our grid. And there are many analysts as well, but that's because of erratic performance in the past. But by and large, I think Adani Group companies have not fared well over the past few years, as we have seen, and that's been a bit of a disappointment after having have so much of promise and created value. I think they have failed to follow through in terms of performance and stock price returns.
Fortis, Deepan, now finally we know who the suitor will be, IHH, and a credible player coming on board rather than a short-term strategic investor. Do you think this could change the game for Fortis, and would you be bullish on the stock?
No, not really, I think, and this upswing could be an opportunity for shareholders to exit out of Fortis. I mean, look at the way other hospital company shares have fared in the past 2-3 years or so. It's a difficult business, and although there is certainly great potential for healthcare, but it's capital intensive and highly competitive, and erstwhile players or existing players in the hospital business, be it Apollo or NH or even some of the other newly listed hospital companies, clearly haven't delivered in terms of top line, bottom line, or return on investment for that matter. And my sense is that Fortis also, once this controversy is over and actually the operations and the investors start focusing on the operations, they will tend to get disappointed going forward, and valuations anyway are, according to us, quite stretched at this point of time. So we would look at this as an opportunity to exit out of Fortis and look for investments outside of the hospital business. And if you still want to be into healthcare, then I think some of the diagnostic companies like Dr. Lal's or Thyrocare may perhaps offer higher returns than pure play hospital companies.
Okay, all right. Well, on that note, let's just get back to our technical experts. Ashwini, so the market's not doing much on the headline index. When we began our chat, you were saying you're okay looking at shorts. That's both on the Nifty and the Nifty Bank, and you'd be okay taking those positions home over the weekend?
I think this is the right time to go short on the market. A, because there is very strong momentum on the downside. And this is not a plain vanilla correction from previous highs. When look at the mid-cap momentum, plus your stops are very close, hardly 11,050, 11,060. So if it starts to work out, it's likely to work out big. So that way we are carrying shorts home, not only on Nifty, Bank Nifty, even on individual stocks, all kinds of JSPL, NCC. These guys will have totally no buyers. And even if Nifty falls 150, 200 points, the mid cap will really get bludgeoned, and a lot of them will make fresh lows. So given that, I think today is the right day to get short. Global cues are not helping. Yesterday they were positive, today they are positive. So that way I think it's relatively safe trade to be short.
And in terms of individual stocks?
NCC is a sell with a stop of 92, target of 84. Engineers India is a sell with a stop of 125, target of 117. And Canara Bank is a sell with a stop of 236, target of 224.
Okay, and Mitesh, what trades would you go with now? Last 20-25 minutes of trade?
Yeah, I have a sell on Biocon. I think after a long time that is breaking down. That's a SCBT with a stop at 608 for targets of 585, and Cholafin is a buy with a stop at 1550 for targets of 1625.
Okay, well, we'll come back to you guys. Cholamandalam actually has been such a great stock, holding up above that 1570 odd mark. But Fortis has been the big story after Fortis and IHH consummated that deal. We spoke to Ashok Seth, the chairman of Fortis Heart Institute, earlier today, and he says that they are confident of providing even better healthcare with the partnership of a long-term investor. Listen in.
It's welcome because it puts an end to a long period of uncertainty, which was certainly affecting operational issues and morale of all the staff of Fortis Healthcare, especially the doctors. And we are obviously looking at a new era in the healthcare industry with the IHH coming in. We are all glad that we are moving away from short-term investors who may have been in it for financial gains to a long-term investor who probably would partner with the ethos of belief of delivering high-quality healthcare. Strength of IHH and the strength of the long-standing clinical force of Fortis Healthcare are the two combinations which are going to deliver healthcare. IHH is going to bring in a lot of its processes into play, some of the benefits that they can provide to us. We are very positive that we would be able to provide that element of partnership which brings in cost-effective quality care to the patients.
Okay, well, on that note, let's take a quick break. We will come back with more market talk on the other side.
Hi guys, welcome back. Well, I know the market has been under pressure in the broader markets, but there are still stocks that are hitting new highs today from the frontliner names, whether it's Reliance Industries, Bajaj Finance, Non-index large caps like Britannia, Marico, Ipca Labs all sitting at new highs. So there is potential to make money in this market. So Deep Bandyopadhyay is also with us, and Dipan Mehta has also been sitting by. Gentlemen, thanks for staying with us on CNBC TV18. Dipan, I wanted to ask you your view on some of these, consumption stocks. I mean, as we speak, names like Britannia hitting new highs. In fact, Britannia is almost at 6,500 now. So in such a volatile year, it's given you returns of almost 40%. You think there's more money to be made in names like this?
Maybe not Britannia, and it's a company in which we and our clients are invested, so wouldn't advise buying at these elevated levels, at least for the time being. But Britannia has done well because it has been an outstanding performer, one of the best performing FMCG companies. But certainly, I think investors want to position for a defensive portfolio. This may be a good time to get into FMCG stocks, and our preference is for the Indian FMCG companies, the likes of say Jyoti Laboratories or Imami, or for that matter Godrej Consumer. And these companies will also benefit from rising rural consumption, which will happen because of better monsoons and higher MSP prices. So yes, I think a fair amount of FMCG exposure should be there in every portfolio. And if you're looking for a defensive play, then I think these are the best stocks to remain invested in. And one could even further extend this consumption story. So some of the other consumption-oriented stocks could be building materials, could be appliances, could be automotive, aviation, retail as well. So I think this entire consumption theme is a fantastic theme for investors to follow and get good returns, good outperforming stocks over there. And FMCG is just one component of it. And in fact, FMCG is growing at a slower growth rate than some of the other sectors, which I spoke about just now.
Okay, all right. Well, we also have Deep Bandyopadhyay, Group Chairman at IndiTrade Capital, joining in the conversation now. Deep, I'll start with the next event for this market. We're all awaiting numbers from Infosys after TCS's stellar show. Obviously, expectations are running high. What would you expect from Infosys, and between the two, which would be your top pick?
Well, Survi, I think you're absolutely right. There are quite a lot of expectation from Infosys. We know this is traditionally a quarter when the wage hike and visa costs have gone up. On the other hand, rupee has depreciated. So by and large, in constant currency terms, the revenue probably will be growing at around 2–2.5%. We expect them to maintain the yearly revenue growth in constant currency terms of around 6 to 8%. What we will be watching out keenly is their kind of status on the BFSI. That's a very, very important segment as far as Infosys is concerned. TCS clearly indicated that the BFSI they are gaining business, and they are kind of very enthused about the BFSI prospects. Let's see what Infosys says. Also, the new CEO has laid quite a bit of emphasis on digital. He has talked elaborately about the business gains which is possible in the digital. So we'll like to see what he talks about the digital and what actual progress has been made on the digital side of the business. Also, we'd like to see what kind of account wins they had during the last quarter and what they are working on. So overall, it will be very interesting. TCS, of course, has done outstandingly well, and Infosys needs to match up to that, or at least needs to kind of try and catch up to that kind of performance. As things stand today, I think I will go and buy, if I have to buy, still TCS for the long term. I'm not saying go and buy today, but between the two stocks, probably I'll still go and buy TCS, because they have clearly demonstrated that they are back on track very clearly for a double-digit growth.
Okay, on that note, in fact, let's listen into what the expectations are from Infosys this time around. Rima is here to tell us more. Of course, Infosys still trades at more than a 30% discount to TCS. So let's see if that valuation gap narrows. But Rima, what can we expect today?
Hi, thanks so much for that. First, a quick run through of the key numbers. Dollar revenue growth seen higher by 1.5% quarter on quarter. In constant currency, it's expected to be a growth of 2.5 to 2.7%. So better than what the company delivered last quarter, but lower than what TCS delivered this quarter, which was a 4.1% growth. Margins will be impacted by a wage hike, visa costs. So that should be lower by 100 basis points to about 23.7%. Profits seen on the flatter side, so just up close to about 1.5%. Key will be what happens comes to their FY19 guidance. Their constant currency revenue guidance of 6 to 8% is likely to be maintained, but their dollar revenue guidance of 7 to 9% could be lowered on account of the dollar strength, which has resulted in cross-currency headwinds. The key to track will be on their margins. Their margin guidance was lowered last time. It was lowered by 100 basis points to 22 to 24%, but since then, the rupee has depreciated by 4 to 5%. So there is a case for the company to do better on the margin front. So therefore, will they look to revise it? Some other internals that we look closely, one will be the performance of the BFSI space. TCS performed well. The management commentary was optimistic, signaling a turnaround. If Infosys also delivers and speaks confidently about BFSI, then you get a sense this is an industry-wide pickup there. Leadership attrition, Infosys has lost senior level people in their healthcare as well as manufacturing heads in the quarter gone by. So that is a worrying point. Outlook on deal wins because it's picked up in the last quarter. In terms of valuations, Infy is still trading at a discount of nearly 30% forward multiple to TCS. And that's because of a divergence in growth. TCS is expected to grow at 10% in constant currency for FY19, while for Infy, it's a 6 to 8% guidance. The company could deliver somewhere in the middle of that. So for the valuation discount to narrow vis-a-vis TCS, the company's growth needs to pick up and come closer to that of TCS. Back to you.
All right, thank you very much for that, Rima. So we are standing by, awaiting those numbers. We'll just go and sort of look at the technicals on these ones first as well. Mitesh, if I could just ask you, I mean, purely on technicals and levels, what are the next ones that you're tracking for Infosys?
See, I think, Infosys, in fact, has met all the upside targets recently. We had the most optimum target around 1300. It hit a high of around 1350, and then since consolidating. So I'm not very clear on Infosys' immediate targets right now. I think if I had the stock, I would possibly be tempted to take profits. But any declines to 1260, 1250, which is where the medium-term supports kick in, would be an excellent buying zone for me.
Okay, we just have about 10 minutes to go before the day comes to an end. So before we continue talking about stocks, let's do one thing. Let's get you a story now. Big ticket rate rationalization is unlikely in the GST Council meet. Remember, the Council meet is scheduled for the 21st of July. Government officials now tell CNBC TV18 that there may not be any big ticket changes there. Timsy Jaipuria joins in with all those exclusive details. Timsy, what are you picking up for us?
Yes, as you rightly mentioned, big-ticket items such as cement, paint, digital cameras are going to be a miss this time in the 21st July GST Council meeting. What I hear from sources is the fact that Revenue Department feels that this is not the right time to tinker with GST rates of these particular items because they want to wait for the kind of revenue that they are aiming to get before they try and put these items under the rate rationalization. Even Fitment Committee is not in favor of reducing GST rates on cement, paint, movie tickets and digital cameras. They feel that revenue stabilization is the key, and once that happens, only then this should be taken forward. Because the revenue impact, if cement, for example, is reduced from 28%, the revenue impact assessed by the Fitment Committee is of about 10,000 odd crores. Similarly, for paint, it is around 5,000 odd crores. So they feel government is not in the position right now to take so much of a hit. Not just this, but there is going to be some relaxation on rates, especially when it comes to products such as handicraft, stationery items, notebooks, school bags, items related to education and social sector, because government feels these items are spread across 12 to 18% and they need some sort of a rationalization. So no big ticket items, but yes, as of now, some smooth sale with items such as stationery, school bags, etc., so that the public sentiment also continues with the rate of
Okay. All right, Timsy, thank you very much for that. Well, we have to take a very quick break on that note. We'll come back and look at the close this Friday afternoon on the other side. Welcome back. There are just about 8 minutes to go before this day closes out. So Deep, one more stock for you, and it's had a very interesting journey. We were just discussing this. Titan on a day like today is up about 4%. It's fallen so much from the top. I mean, coming back to those 800 kind of levels. Would you buy it at this moment?
Absolutely. In fact, I was listening to the conversation you guys were having with some of our other guests, I think it's an excellent story. Yes, there was a large investor who did exit part of his holding. Yes, there were certain the management cautioned about the quarterly earnings because this is a traditionally soft quarter and the jewelry sales may be a little subdued. But I don't think any of these takes us can take us away from the fact that it's a fantastic brand. They are undoubtedly the leader. They are gaining market share post that entire Gitanjali and Nirav Modi fiasco, and even to an extent the PC Jewelers kind of related issues. The market confidence and the consumer confidence in this company is bound to only increase. With all that happening, I think, and with the significant correction which Titan has seen over the last couple of months, I think it's a great buy for an investor with a slightly longer term horizon. So at current level, definitely it should be in the investor's shopping list.
Okay, well, Dipan, we're just counting down to close, and in any minute now we'll get the Infosys numbers. I know this is, this is one space that you've completely stayed out of, and you've missed the rally as well. But on Infosys, if the numbers delivered are sort of better than what the street expects, do you think there's any structural change that's happening here, any inflection point that the sector has reached, or is this still a trading rally that you would exit out of at every opportunity?
I think it's still a trading rally. There are no structural changes or inflection points which have been reached. What we are seeing is a cyclical upswing in a stagnating industry, and there are many companies struggling to get double-digit growth. And although they may get double-digit growth for this year, I do not understand, I don't have the visibility how double-digit growth for even a TCS, Infosys, Wipro, HCL, Tech Mahindra can be maintained sustainably over the next 3 to 5 years or so. And my sense is that I think valuations have risen adequately to even factor in this so-called double-digit growth. And my sense is that going forward, these companies may not deliver good returns. It's just that investors who want low single-digit or kind of low double-digit growth are welcome to invest in software companies. But from our perspective, the best money is made in companies which are able to grow in the high teens or about 25 to 30% type of top line, bottom line growth. Could be large cap, could be mid cap, and there are many such opportunities in the Indian stock market. So that's where our focus and investments are, rather than in businesses which are stagnating at 8 to 10% type of top line growth. And challenges on margin will remain for the industry. They may have a bit of a relief because of the earnings, because of rupee depreciation, but by and large, pricing increases for traditional businesses are extremely difficult because of competition. And costs in India keep on rising, I think, in terms of increments, in terms of establishment costs, could be energy costs, maintenance costs, so on and so forth. So the entire picture for IT doesn't look that pretty over the next 3 to 5 years or so. But I think this year could be good for IT companies, and the trading bounce may have some more space to go up.
Okay. All right, Dipan, you have a good weekend. Thanks very much for joining in. We'll see how those Infosys numbers ultimately play out. By the way, there's one stock which is on a hectic recovery path. It's Inox. I don't know, is there a differential order that maybe in some of the South Bombay theatres you can't still take your food, or that's on a lighter note? But I think there's a massive recovery on Inox right now underway.
As even the gentleman from Mukta Arts was telling us, I mean, this is still a PIL that's being challenged in court, right? There's no final ruling that's come out just yet. So until the PIL hearings, I think on the 27th, until you don't get details from that, you can't say for sure if this will actually come through or not.
Yeah, well, there's some recovery on the stocks. PVR is still completely off the radar. But Inox and Mukta Arts are the two ones that are seeing quick recovery. Just about 4 minutes to go. Sudeep, buy this dip, or is it too risky? I mean, look at that chart on Inox Leisure. It's almost trying to touch the positive side again.
Well, I think there is an element of risk, definitely, as far as buying these two stocks are concerned. We all know that a significant portion of their profit and profitability does come from the food and beverage sales in the theatres. Also, remember, this year hasn't been a great year for the box office yet. Yes, there were a couple of big blockbusters, but many of the kind of big movies haven't done as well as expected. So there is obviously a pressure, and on top of that, if this thing happens, obviously it's a matter of great concern for these companies and the investors therein. So it's better to be cautious at this stage, not jump into buying these stocks yet.
Actually, that's interesting because not just this ruling or the possibility of this ruling, but also content consumption has changed quite a bit. It's moved out of theatres and into a sort of a digital, mobile consumption is picking up. So that structural change is also something people are talking about seriously that could impact these companies. Nevertheless, we have about 2.5 minutes more to go. I wouldn't mind, for one, taking food from home and going and watching it in the theatre. I mean, given how exorbitant the prices are lately. But in any case, Ashwini, your final thoughts on the markets itself? I mean, it's been a quiet day today. Give and take everything, this market has put on weight this week. But you think that's it's just a sucker's rally and perhaps something that would get sold into next week?
I would think so, because we are stalling at previous highs, and the way it's collapsing, not the large cap but mid cap, several stocks, it does not look like we are immediately going to cross 11,050. Now things can be different. If you are wrong, your stops are very close by. So that way, trading wise, this is a nice place, very low risk to take shorts. It's totally baffling that if inflation is coming down, bond yields should be falling, then financials should be going up. The kind of hammering they are seeing, it just looks like very strong bout of profit booking. If I have to buy, probably 10,900 would be a good place to buy, but at 11,050 the market is finding it tough going, and once HDFC Bank, Kotak, Reliance, etc. start to come off, then you could have even a nifty decline also of a couple of 100 points coming through. Okay.
Well, the last 1 odd minute left. I guess we can just quickly start counting down to the week. Week that's been interesting. I mean, 2% up, yes, if you're looking at the benchmark indices. But the mid-cap index fall has really left a very sour taste in the mouth. For what it's worth, the Nifty is going home absolutely flat for the day. It had some support in the form of a couple of the tech names. Infosys, of course, is going into earnings pretty strong, 2.5% on the higher side. It had a decent company in the form of TCS today. Wipro's had some green as well. So most of technology has been all right. HCL Tech has actually reacted negatively after the buyback announcement was out with the pricing, etc. That stock's down about 2%, didn't participate today. Otherwise, support kept coming in from the HDFC twins, both of them up about 0.5% to 1%. Reliance was the other leg of this market that prevented a broader collapse. You had Asian Paints also contributing about 1% or so thereabouts. So all of these stocks ensured that we have a close above 11,000. Titan has had a good rally today once again after this big fall that we've seen. Stock was up about 4% today. Some of the OMCs have managed a little bit of green on the screen. So IOC, BPCL, these were some of the stocks on the upside. However, even on the index, the balancing act continued, because on the downside, you had an equal number of big names. ITC, for starters, down about 2.5%. ONGC's lost about 3%. SBI and ICICI Bank chose to sit out of the move today. So these were stocks on the downside. And some weakness in a couple of auto names. For instance, Hero Moto, Tata Motors, M&M. Auto as a pack didn't do too well. Weakest stock on the Nifty 50 was 4.5% down, Z Entertainment. But the story really wasn't even about this index. It's all about the mid-caps, as always, Sonia.
Oh, absolutely. Today, the mid-cap index fell more than 200 points. It was down more than 1%. The market breadth was so weak today. And a lot of stocks, whether it's a Karnataka Bank, posted its numbers. You had JSPL down about 5%. PVR was under so much pressure because of the news flow. Future consumers seeing profit taking there. You had REC, PFC, HCC all down about 3 to 5%. Lot of PSU banks, Canara Bank, etc. were down under pressure. So it wasn't a pretty picture at all. On the upside, though, you had the Adani Group stocks that looked okay. Adani Enterprise, Adani Power, etc. Fortis Healthcare post that deal closed up in the green. And a couple of other stocks, the likes of IOC, etc. were just about okay, up about 1.5%. But we closed the day flat. But the week has ended on a positive note. So the Nifty goes up with 2.5% gains this week. Sensex up about 2.5% as well. Sudeep, any of the non-index large caps or large cap stocks that you're buying at the moment? I mean, what does your shopping basket look like?
Well, I think, on the non-index side, we talked about Titan. We also, on the index side, we are very bullish on Maruti after the correction. I think, the entire consumption theme in India, I think, is robust. Rural income is definitely going up with the monsoon, the way it's shaping up. Hopefully, it will continue this way. And of course, it's an election year, so there will be a lot of money in the rural markets, and that will give a lot of consumption boost. So a company like a Maruti is definitely a buy at current level. We are having a target of about 11,000. We also like a company like a Voltas. I think it's excellently positioned. They have an excellent market share in North India. Their AC inverter is doing pretty well, and of course, the entire rural electrification thing is helping them in a big way.
Okay. All right, Sudeep, we'll leave it on that note then. Thank you very much for joining in and taking us through market close. We'll thank Ashwin and Mitesh as well on that note. We'll take a break. On the other side, yes, we are awaiting Infosys earnings. They could be out any moment. But just before that happens, let's see if we can try and give you some weekend ideas on Closing Bell Recommends. Mac, you're watching Closing Bell. So, yes, we are awaiting those Infosys numbers. So, before that, a couple of interesting things lined up for you. Chinese manufacturer Oppo has launched its latest flagship smartphone in India, and it's called Find X. The biggest highlight of the phone is its mechanical camera slider. Telling us more is CNBC TV18's Megha Vishwanath.
Screens without bezels, AI-powered camera and a notch display. These three features have pretty much summed up all 2018 flagship devices. So it was no surprise that I've been craving to see something new, something different. And I found it in Oppo's brand new Find X that's 90-minute way to India. Quick tech fact, Oppo is a Chinese hardware brand that also owns OnePlus and the new budget brand Realme. Coming back to this device, here's what makes this stand up.
I bet you missed it. So let's take a closer look. Oppo's new Find X packs in this gimmicky motorized camera that is completely hidden under an extremely large 6.4-inch display. How does it work? Well, when you fire up the camera app, the top section of the phone slides up. What you then see is a 25-megapixel front-facing camera, a dual 16 plus 20 megapixel rear camera setup, and the 3D facial scanning system. All this information means that the company has managed to ditch the iPhone X-like notch and the camera bump on the back panel. And that's a breath of fresh air right there.
The company claims that it only takes 0.5 seconds for the camera to slide up, and having played around with this device for a bit, I agree. Apart from this camera trick, pun intended, the other highlight of the Oppo Find X is the curved glass on the hardware, which will remind you a lot of Samsung Galaxy's S9 Plus. And no, I don't mean this in a negative way. It actually adds that extra punch of premium.
While there's so much tech packed into this device, Oppo has sadly not matched back in a headphone jack, nor is this phone water resistant. Also, the Find X does not house a fingerprint sensor, but that's because it uses the 3D facial scanner for biometric authentication. Under the hood, Oppo Find X packs in all the top-of-the-line 2018 flagship specs like a Qualcomm Snapdragon 845 processor, 8 GB of RAM, 3730 mAh battery, and a storage goes up to 256 GB.
Now, having reviewed dozens of smartphones this year, I must admit that the notch that most of the flagships seem to be spotting these days has begun to grow on me. But a notch-free, bezel-less display will always remain my top pick. Having said that, I am a little worried about the motorized camera on this one. What happens if you accidentally drop your phone? And no, I have not tried that myself. So there is a risk factor unless you're the kind of person who has never dropped a phone in your life. If that's the case, then the Find X will be yours for 59,990 rupees. With that, to happen this edition of CNBC TV18 Tech Toys. I will see you next time.
Well, right now, before we get down to all those weekend plans, yes, is earnings still ahead, and Infosys would be reporting numbers in any time now in the next 15-20 minutes. So let's get you a preview. The bellwether does have very high standards ahead of it. Considering what TCS has done, we have Rima joining in with the key highlights that are expected from Infosys this time around.
Hi, thanks so much for that. First, a quick run through the key numbers. Dollar revenue growth seen higher by 1.5% quarter on quarter. In constant currency, it's expected to be a growth of 2.5 to 2.7%. So better than what the company delivered last quarter, but lower than what TCS delivered this quarter, which was a 4.1% growth. Margins will be impacted by a wage hike, visa costs, so that should be lower by 100 basis points to about 23.7%. Profits seen on the flatter side to just up close to about 1.5%. Key will be what happens to their FY19 guidance. Their constant currency revenue guidance of 6 to 8% is likely to be maintained, but their dollar revenue guidance of 7 to 9% could be lowered on account of the dollar strength, which has resulted in cross-currency headwinds. The key to track will be on their margins. Their margin guidance was lowered last time. It was lowered by 100 basis points to 22 to 24%, but since then, the rupee has depreciated by 4 to 5%. So there is a case for the company to do better on the margin front. So therefore, will they look to revise it? Some other internals that we look closely, one will be the performance of the BFSI space. TCS performed well. The management commentary was optimistic, signaling a turnaround. If Infosys also delivers and speaks confidently about BFSI, then you get a sense this is an industry-wide pickup there. Leadership attrition. Infosys has lost senior level people in their healthcare as well as manufacturing heads in the quarter gone by. So that is a worrying point. Outlook on deal wins because it's picked up in the last quarter. In terms of valuations, Infy is still trading at a discount of nearly 30% forward multiple to TCS. And that's because of a divergence in growth. TCS is expected to grow at 10% in constant currency for FY19, while for Infy, it's a 6 to 8% guidance. The company could deliver somewhere in the middle of that. So for the valuation discount to narrow vis-a-vis TCS, the company's growth needs to pick up and come closer to that of TCS. Back to you.
Okay, thank you, Rima. Thanks very much for that preview. Well, we will get back to Infosys as soon as those numbers are out. But right now, another story. After failing to recover even half of the proceeds of the alleged crime committed by Nirav Modi and Mehul Choksi, the Enforcement Directorate is now going after their assets outside India. Utkarsh joins in with more details. Utkarsh, isn't trying to go after overseas assets going to be perhaps a lot harder?
Exactly, Surbhi. This is the case, and that is the reason why normally investigating agencies look to seize the proceeds of crime within the country only, as it happened in the Vijay Mallya case. But in this case, what has happened is that the proceeds of it's only half and less than half, in fact, only 4,000 crores has been recovered from the country itself. So now to recover the proceeds of crime, the Enforcement Directorate will look at seizing properties abroad. Now, they have sent letter rogatories to around 15 countries who have already responded. UK and UAE have responded, and from those letter rogatories, it has been revealed that around 10 flats and some commercial properties are being found in both of these countries. ED will also wait for information from other countries, and then it will move ahead for the process. We haven't really checked what is the exact process and how can really ED move forward attaching assets in foreign countries. But it will be a harder task than to be done in India. But given the fact that only 1/3 of the amount has been confiscated till now, ED will have to go through the harder route.
Okay. All right, Utkarsh. Thank you very much for getting us that update. Moving on now, the Troika at Jyoti Laboratories, the founder, the daughter and the joint MD came together to talk to us for the first time. They speak about their business targets, the legacy forward, and also the iconic Aya Naya Ujala campaign. They were in conversation with none other than Mangalam Madhu. Take a look.
My father started it from a very small, 5,000 rupees or so. And today where it is definitely a pressure, obviously, to perform to his standards, because it's really difficult to match his standards, his hard work and his passion. We still can't really compete with him on passion, definitely. I try my best to actually, imbibe those things within me and try to learn a lot.
What was the most important thing that you learned from him?
Hard work. Hard work and sincerity is the thing that I learned from him. The rest, obviously, as you go along, you get to know things. But this is one thing which you can't match.
Aya Naya Ujala Char Boondo Wala. How did that campaign come about?
See, Ujala was initially launched only in Kerala. And we got into the minds of the people with that local type of, folk songs and things like that. It really went into their mind. Mr. Anjan Chatterjee was the real author of that Aya Naya Ujala Char Boondo Wala. He had really, when we got into touch, when he took that brand into his hand, he told that, yes, simply telling us not, let me go and see there in Kerala also and in Tamil Nadu also. A lot of money was spent on that one across India. Even perhaps almost about more than 50% of the revenue also was spent on creating that.
And that was money well spent, I think.
Yeah, very well spent. And that has given us that freedom of that, and also that intuition. Now we can get into many other things. That was really, even today, that is reverberating in the minds of the people.
Absolutely. I keep saying that, anything to do with Boond, it's either Do Boond Zindagi Ke from the polio campaign or Aaya Naya Ujala, Char Boondon Wala.
And it was his word that Char Boondon Wala, once we take that one, nobody will come out with one Boond. Ek Boond ya do Boond, because Boond belongs to us. And it really happened so.
One thing that I noticed was that you gave less dividend this year. Are you shoring up your balance sheet for an acquisition? Can we hear something very soon?
Not very soon. It was definitely your thinking was right, and we reduced our dividend to reduce our debt so that balance sheet will be able to leverage it better if at all if we get a good acquisition candidate. We are looking for it, and we've also taken the new CFO now. He'll be more focused on M&A. So we are looking at it.
He's come from investment banking background and a Macquarie guy, if you
absolutely, absolutely. And he's his 50% of time will be to look for the brands for us to acquire. So we're keeping our war chest ready.
So a war chest would be, how big is the war chest?
It should be, we are targeting maximum spend of about 800 to 1,000 crore, not beyond that. This is all what we can digest at this point in time. And according to me, now that Henkel is behind us, every 4 or 5 years we should be able to do a sizable acquisition and take it to the next level.
And what segment is that you're looking at?
We'll be very comfortable in the segment where we are presently now. But at the same time, if we get any adjacent area like hair care or body care, we don't mind looking at that as well. But we need to see that every product, every business what we acquire, that should get into this million retail outlets within 30 days time. That's our reach.
The road to 5,000 crores in terms of revenue, when does that happen? How does that happen? What leads it?
It should happen by 2022. Our internal target is to double the turnover in the next 3-4 years. So by 2021, we should be about 4,000, and with 15% organic growth and balanced by inorganic growth. So my calculation is about 12% we should get from inorganic growth to reach that number. And we have plans for that.
You've laid out a war chest of 1,000 crores for inorganic growth.
Absolutely.
And acquisition should happen in FY19, FY20?
It should happen in FY20. FY19 will be ready. FY20 it will happen.
All right. At 5,000 crore, what does the margin profile of the company look like?
With our experience in the last 5 years as a management team, we have decided that we will not get into any business which is less than 50% gross margin, less than 17% EBITDA margin, and that will be the profile going forward also.
And ad spends, at one point you all spent 50% of your revenue in advertisements, which was the Ujala campaign. Now it's about 9.5–10%. Where will that be?
In fact, you said it right. When we are 80 crore business, 35 crores advertisement budget only on Ujala. 14% is what we think is more than sufficient for us to spend on advertisement and promotion. And as of now, we are at that level. If required, 1 or 2% we increase, but otherwise, healthy growth with a healthy spend is what we are looking at.
How is the future consumer different from the consumer that your father catered to?
They are very well informed now. It's not like how it was in the past. Information is in plenty. Options are many. So you have to be very, very true to what you offer. They have a lot of choices there, and if you're truly different, it makes a difference in their lives. That's where you win the game.
I started the chat by asking Jyoti what she admires the most about you. So it's only fair that I ask you, what do you admire the most about Jyoti?
I admire that one is that she is independent, and she talks about the modern generation only, modern way of thinking, modern way of management. And that is in her.
Are you confident enough on her ability to go ahead and lead the way you want it?
The world is moving very, very fast. So accordingly, I have found talent in her, and I don't have any doubt in their capability of taking the company forward.
सुनो, टिम के पापा के लिए ये हैट कैसे रहेगा?
ऑनलाइन? पागल हो क्या?
क्यों?
PayPal है पापा, safe है.
PayPal?
Done.
Hello, namaste.
We have something small for you. Oh wow! And we got something as well from India. All right, online. Yes, online. Ah, PayPal. PayPal, yeah.
Accepted by 90 million merchants across 200 markets. PayPal.
Safe है?
कल देखे सो आज देखे सो right now. कम ज्यादा क्या
Welcome back, and just coming back to diamonds yet again. And before we got on to that Jyoti Labs interview, remember it was Karsh telling you on how there are more implications happening in sense of Nirav Modi and also the Gitanjali group. There are some more serious issues that really seem to be coming in for the diamond industry right now. The latest that has come in is that DRI has now busted a multi-crore diamond import scam. What we are given to understand is that the diamond merchants had inflated the value of diamond imports here. Remember, they actually used the route to transfer the black money out of country. What the DRI also goes on to say in that report is that 14 consignments of rough diamond imports were valued at 156 crores. But once they checked it, it actually was just about 1.2 crores. So that is how the level of that is how it was inflated, really. There is, of course, a response from GJPC on that they had been sensitizing government over the overvaluation of imports, especially from Hong Kong. And GJPC in its press release goes on to say that there is documentary evidence of efforts and support that the association was actually giving on to the government agency. So there's plenty clearly happening when it comes to diamonds from here on as well. We, of course, will continue to follow that story. But joining us also to talk about that and commodity strategies is Sumit Bagaria from Choice Booking. Sumit, hi, good to have you. Clearly when it comes to precious metals, there is no dearth of stories, positive and negative. What continues to keep happening in diamond definitely has impacted the diamond jewelry trade in a big way. How have you seen the physical buying in gold and silver in that sense? And what's your sense on the prices going forward?
Hi, Manisha. Well, as far as a view on gold and silver is concerned, in the last couple of weeks, what we have seen is that from higher levels, we have seen a correction in both the commodities. Now, looking at the chart, it seems that COMEX gold can give some more correction from present levels, in which we can see levels of around $12.20 or even $12.10 in next couple of days. Upside is resistance at around $12.50, $12.55. Till the time these levels are not taken away, it's better to be on sell side in gold. M6 levels, we can expect gold prices to move down and touch level from 29,800 levels. I think for a trading perspective, one can initiate sell positions in the gold August contract at the current market price. If there is a pullback of around 50 to 100 points from present levels, then that should be used as a selling opportunity, with a strict stop loss to be placed at 3,300 levels on high side for the downside target of 2,900 and 2,900 levels in the next couple of days.
Also, how are you looking at the crude oil prices? Because we are ending a second straight week of decline, 5% down on the crude varieties here. Would you say we are close to bottom, or is this really going to be the range going forward for next week or so?
I think for next couple of weeks, the immediate range for crude NYMEX is placed between $65, $66 on lower side to $74 on higher side. From present levels, there is a possibility of around correction of around $2. If we see such correction, then at lower levels, one can initiate long positions for the targets of $74, $75 in next couple of weeks. Immediately, purely for a trading perspective, for next 1 or 2 days, one should initiate sell position in a crude July contract at around 48.20 or 4800 levels, with a stop loss to be placed at 48.90 on higher side for the downside target of 4700 and 4680 levels. I think it's better to play in a range for next couple of days. The overall range for crude in M6 is placed between 5,000 on higher side to 4,600 on lower side.
Also coming on the metal space, because while of course we've seen buying in bits and pieces, especially when it comes to the ferrous metals, where steel prices are trading at a 10-month highs. Nickel actually seems to be closing this week on the positive. Can't say the same about the other metals, because copper, zinc, lead clearly have been the losers in the metal pack in this week.
Yes, you are absolutely right. Copper, zinc, lead has given a sharp correction from higher levels, and some of the commodities have given a good upside move. But overall, looking at the base metal pack, it seems that for next couple of days we might see some correction in most of the base metals. Now, for a trading perspective, I think one can initiate sell positions in nickel at between 960 or 970 levels, with a stop loss to be placed at 985 levels on lower side. And on downside, we can see levels of around 930, or there is a possibility that we might see levels of around 920 also in next 3 to 4 days time horizon.
All right, so it's mostly sell calls in the metal space, precious and base metals. Sumit, thank you so much for joining us and giving us your strategies. And with that, that's a wrap up on this edition of Closing Bell. But after the bell continues all the action forward.